Hi, my name is Wang Yao,
And my name is Charlie.
and we're going to be doing on the AUD to GBP and AUD to USD. So the first factor that I used to estimate the foreign exchange between the GBP and the AUD was the interest rate. So if you look at the graph, you can see that the Australian interest rate has been holding constant at 1.5% in recent years. And the interest rate of the UK has dropped from 2%, it has been dropped from 0.5% to 0.25%. So from what we can see that there's a difference of 1.25% between the interest rate of Australian and the UK's. So Australian having a higher interest rate would attract more investors to invest in their country due to the higher return. So what do the investors have to do? They have to purchase AUD in order to invest in Australia. So this increases the demand of the Australian dollar, which would cause it to appreciate against the British pound. Now, the UK has a relatively low interest rate. Now, what would this do? It would lead to consumers borrowing more money and they would have more spending power. Now, more spending power means that the economy is going to be growing, and this would lead to the inflation of the UK. Now, this leads to my second point, the inflation rate. So, if you can see from the chart, it shows that the inflation rate of the UK has increased from 1% to 2.9%. while the inflation rate of Australia has increased from 1.3% to 1.9%. Now, a higher inflation rate shows that the price of the goods in UK is going to increase faster than the price of the goods in Australia. Now, what does this mean? It means that the goods of UK are getting more expensive for foreign countries to purchase. Now, this would decrease the demand of the export from UK to other countries. This leads to a lower demand of GBP because people would less likely to be purchasing the goods of UK nowadays. But in another way, having a high inflation rate in UK as well caused the people in the UK to purchase more imported goods. Now, when they purchase more imported goods, they have to exchange their British pound for another currency. Now, what this does is that it increases the supply of the British pound, causes it to depreciate against the AUD.
The GBP was sold heavily last year on the back of the Brexit referendum, as seen on the graph in the June-July section, where it dropped dramatically due to the announcement and results. The uncertainty of what was to happen with the UK voting to leave has weighed down on the GBP. This doubt led to widespread selling of the pound, which weakened against the AUD. The weakness of the pound post-Brexit was initially seen as an issue, but this has led to the price of goods, UK goods, becoming cheaper for the overseas customers, and there has been an increase in demand for UK-produced goods, which has had a positive impact on their manufacturers and hence the UK economy. On the downside, the costs of overseas goods have increased, and this has contributed to a pickup in inflation. In response to these inflationary pressures, the Bank of England has indicated that there will be a rate rise, and that a rate rise is now back on the cards and may happen sooner rather than later. This caught the market by surprise, forcing the currency higher than I would have thought. This rise may have been partly due to the market speculators covering some or all of their bearish pound positions. The Bank of England has hinted to a November interest rate increase. Financial markets are now pricing a roughly 50% probability that the rates will rise from the current record low, with a rate hike that is fully priced in by February 2018. The Bank of England head wants to return inflation to 2% target, currently 2.6, in a sustainable manner, so there may need to be some adjustments of interest rates in the coming months. If growth remains strong, which is likely based on the current business survey readings, and inflation continues to accelerate, we will not be surprised if the Bank of England increases its policy rate before the end of 2017. If the RBA holds firm in the meantime, the GBP should rally against the AUD until halfway through next year, where there is a growing consensus the RBA may raise rates once or twice in the second half of 2018. At present, the US interest rates are lower than Australia, 1 to 1.25% compared to 1.5%. Although the difference is small, This could be one factor to help explain the fall in the USD against the Australian dollar. Other indicators such as inflation and GBP rates do not lend to support the recent decline in the USD against the AUD argument, as the inflation numbers are very similar and the current stronger GDP numbers suggest a stronger US dollar. This would suggest that there are other factors at work contributing to a weaker USD versus AUD. According to a recent Bloomberg article, the USD's recent slump has been fueled in part by lackluster economic data and sinking confidence in the Trump administration ability to carry out pro-growth policies. As a result, the market has been shorting the US dollar and is now considered by some analysts to be the most crowded trade in foreign exchange. It is currently the biggest net short position on the US dollar in more than 4 years. According to a recent Citibank report, the AUD hasn't appreciated 11% versus the USD, but the USD has depreciated by that margin since its peak in December last year, at 72.1 cents to a recent low of 81.21 cents on September the 8th. I am of the opinion that the bearishness may have gone too far, especially now that the Federal Reserve announcing last night a start date of October 2017 for them to begin to reduce their $4.5 trillion balance sheet. This usually results in tighter monetary policies. The current consensus in the market is that the Feds will raise interest rates again in December 2017. I'm of course assuming the RBA stays on hold in the short term, although we are hearing more calls for the RBA to hike at least once in 2018, and most likely in the second half of that year. In the short term, I predict the USD AUD will trade between the ranges of 76 to 80 US cents. The only risk here is that if there was any progress in the US tax reform or a stimulus bill was introduced, this could force the market speculators to cover their bearish positions, which could quickly cause a violent squeeze in the USD AUD exchange rate.
Adrian will continue.
The strength of the AUD USD is looking to be positive, but with mixed forecasts from different economic analysis. HSBC is forecasting mid-90s against the USD by mid-2018, while National Bank is forecasting mid-70s. The National Bank estimates there will be an increase in the domestic cash rate of 100 basis points by December 2018, for a total of 2.5%. If the US cash rate does not increase to this level, or is hiked at a lower rate of increase than the Australian cash rate, the Australian economy will remain the more desirable place for investors to spend their money. This places further upward pressure on the value of the AUD, as American investors will shift funds from the US, convert to AUD, increasing demand for AUD, therefore appreciating the currency. The outlook is contradictory from the National Bank regarding the strength of the AUD, as if the cash rate increases, there is an expected increase in the AUD's value as investors receive greater returns relative to other countries if they invest their funds in the Australian market. This forecast is based on a 12-month outlook. If the Federal Reserve of America increases their rates before the RBA, there will be a short-term depreciation in the AUD against the US dollar. But as the RBA rate increases come, there will be a long-term appreciation. Current pricing for iron ore is $73.84. In January 2017, it hit 82 and went as low as 52 in May. The appreciation in the value of iron ore can be seen as a factor in the strengthening of the AUD over the course of 2017. From a low of roughly 73.50 to now 79 expressed in USD, the NAB forecast is that the price of iron ore will decrease $12 to the June quarter 2018. If this comes to fruition, the AUD will depreciate on average. This is only one outlet's forecast, however. There is widespread speculation that the Indian economy will enter a boom with strong rates of economic growth and therefore investment infrastructure. If this is so, in the long term, it will place upward pressure on the commodity prices and therefore the value of AUD. However, in the short term, it is likely that commodity prices will decline, placing downward pressure on the AUD.